So far, over the first 6 lectures in this course, we've discussed some very fundamental and general issues concerning an effective investment strategy. All of this discussion was done at mostly a conceptual level. As you no doubt were thinking, many of these general and conceptual discussions begged questions such as, but how do I actually decide what to do? How do I decide whether to buy 100 shares or 1,000 shares? What exactly should I be willing to pay for a particular security? What critical values of what variables indicate whether or how much I should invest in international securities? How much interest rate risk does my portfolio contain? And what size position in what kinds of securities will help me reduce my exposure? All of these questions are quantitative questions. In the next few lectures, we'll develop a set of tools that are used in subsequent lectures to answer these very specific quantitative questions. In this lecture, we'll start by examining one of the most basic building blocks in any financial valuation method, namely the concept of the time value of money. From this, we will obtain various formula and present value for the present value, future value, and the net present value. With these concepts and formula, we'll be able to calculate a number of variables and values of interest, including 1. How much money do you need to save for retirement, given an expected return on your investments? What's the value of a bond? And what's the value of a stock? So let's start by defining the concept of the time value of money. This concept is fundamental to finance in that it allows us to compare cash flows that arrive at different points in time. The time value of money is at the center of any investment decision, since you are always deciding whether it makes sense to pay the market price for a security now in order to get something, usually uncertain, in the future. The time value of money part takes care of the difference between now and the future. That's actually the easy part. Most of the rest of the course is focused on the hard part, the uncertain part. What is the value of some uncertain payment? The concept of the time value of money is the notion that, for most people, $1 today is worth more than $1 tomorrow. To see whether this is true or not, consider how you would react if someone were to offer to sell you a promise to pay you $1 a year from now. How much would you be willing to pay for this promise? Probably less than $1. But why? There are a couple of obvious possible answers. One has to do with the expectation of inflation. If the price of goods will be higher in a year, the dollar you give up today will buy less consumption in a year. So you will want to give up less than $1 today so that you get at least as much consumption in the future as you gave up today. Another answer has to do with the postponement of consumption. If you give up the price of the security today, you can't buy anything with that money today. In order to want to postpone consumption, you will need to be rewarded with the expectation of more future consumption than you give up today. The third answer concerns default risk. There's a chance that the person promising you $1 a year from now may not actually pay you $1 a year from now, i.e. that person might default. Given the possibility that you might not get all of your dollar back in a year, you don't want to give up a whole dollar today. These 3 reasons all make it such that $1 in the future is worth less than $1 today. This difference manifests itself in financial markets as a positive interest rate. The interest rate is simply the fraction of the initial amount paid that you get extra for giving up that amount today. If you paid 95 cents to get $1 in a year, then the annual interest rate is 5 divided by 95, or 0.0526, or 5.26%. You get 5 cents more than the 95 cents you paid. Since 5 cents is 5.26% of 95 cents, the interest rate is 5.26%. By the way, there are many other names for the interest rate, including the discount rate, the opportunity cost of capital, the required rate of return, and the capitalization or simply cap rate. They all mean the same thing. A final reason for the time value of money is the fact that the market pays an interest rate. The market requires that you give up less than $1 to get $1 in a year. That is one reason $1 in a year is worth less than $1 today is because of opportunity costs. The opportunity cost of some action, say for example an investment, is that you give up something by not doing that action. So one reason you would pay less than $1 for a promise to get $1 in a year is because if you did give up a whole dollar, you would be missing the opportunity to give up less than $1 to the market to get $1 in a year. That is, $1 in the future is worth less to you today because the market gives you the opportunity to give up less than $1 to get $1 in the future. This time value of money notion gives rise to two formulas. The first is the future value formula, while the second is the present value formula. In terms of the timing convention we'll use throughout the course, we will say that payments occur at specific times relative to the current period, which we will denote by t equals 0. We will count time relative to the current period in years. Thus, 1 year later is t equals 1, while 4.5 years from now is t equals 4.5. Exactly 1 year ago will be denoted t equals minus 1. Consider a specific cash flow in the current period. Let's call this CF sub 0. The future value translates CF sub 0 into its equivalent future value after t years given an annual interest rate. Let the future value after t be denoted FV sub t, and let the annual interest rate be denoted by R. To do this translation, we take the current cash flow, CF sub 0, and merely multiply it by the quantity 1 plus the interest rate for each year until we get to the targeted future date. That is, after 1 year, the future value is CF sub 0 times 1 plus R. After another year, the value grows for 1 more year to CF sub 0 times 1 plus R times 1 plus R. After t years, CF sub 0 has grown to its future value of FV sub t is equal to CF sub 0 times 1 plus R all raised to the t. So for example, if you have a current cash flow of $100 and the interest rate is 10%, then the future value of this $100 after 10 years is $100 times 1.1 raised to the 10th power, and that's equal to $259.37. The notion of the present value simply puts the future value notion on its head. Rather than answer the question, what future value is equivalent to a given cash flow now, it asks what value now, in the present period, is equivalent to a given payment in the future. Thus, if someone were to give you a promise to pay a cash flow of CF sub t in t years from now, you would view that as a promise that is equivalent to what? CF sub t divided by 1 plus R raised to the t now. This is true because according to the future value formula, you can take the current amount and generate what? CF sub t in the future. Notice that if you take CF sub t divided by 1 plus R raised to the t and multiply that by 1 plus R raised to the t, that simply equals CF sub t, which is the amount that you were promised at t. Thus, a cash flow CF sub t at t years into the future is exactly worth CF sub t divided by 1 plus R raised to the t now. For example, a cash flow of $259.37 in 10 years is equivalent to $100 now. Or if we take 259.37 divided by 1.1 raised to the 10th, that's equal to 100. Similarly, $100 in 5 years at 5% annual interest is going to be worth what? 100 divided by 1.05 raised to the 5th power, and that's $78.35. Note that in all of these calculations, you should use the decimal version of percent, that is, use 0.05 for 5%. Do not use 5 for 5%. The future value CF sub t promised in the future is discounted to get the present value in the sense that it is multiplied by a number which is less than 1. And that number is 1 divided by 1 plus the interest rate raised to the t. For example, if r is equal to 10%, 0.1, then 1 over 1 plus r is equal to what? 0.909. Thus, a dollar 1 year from now is worth the discounted value of 90.9% of that dollar. A dollar 2 years from now would be the discounted value of its discounted value next year. Next year, you will get a dollar in a year. Thus, next year, that promise will be worth, what, 1 times 0.909 or 90.9 cents. If that's what it's worth next year, then the present value today must be worth 90.9% of that, or 90.9 times 90.9, which is equal to 82.6% of that $1 2 years from now. Thus, the present value of a dollar in 2 years is equal to 1 divided by 1.1 raised to the 2, which is the same as 1 times 0.909 squared. That is, the future value 2 years in the future is discounted twice, once for each year. Note that the more years into the future, the greater the discount. That is, over t years into the future, you get multiplied by 1 over 1 plus the interest rate raised to the t. As time into the future gets bigger, the present value is a smaller fraction of that future value. Thus, the discount is larger. Also, the greater the interest rate r, the greater the discounting. The smaller is the fraction 1 over 1 plus r raised to the t. Let's do an example. Say you have your eye on a BMW, but you don't have enough money right now, and that BMW is going to cost $48,000, say in 2 years. How much do you have to save today if you're going to have $48,000 in 2 years? Let's say if you can invest at 6%. The answer is, what's the present value of $48,000 discounted back 2 years? So take $48,000, divide by 1 plus 0.06, raise that to the second power, that equals $42,719.83. The methods described above can be applied to a set of multiple payments because of something called value additivity. Basically, what we did above was we figured out what was the present value of a single payment. Now what we're going to do is we're going to consider a stream of multiple payments. Value additivity implies that the present value of a collection of future payments with each individual payment at some different future date is simply the sum of the individual present values associated with each of the different future payments. Put more simply, value additivity is simply that the whole is worth the sum of the parts. While this may not be true for some non-financial things like marriage or a corporation comprised of synergistic divisions or a work of art, it is true for financial securities and cash flows. Value additivity is true in finance because of financial engineering, which allows us to combine individual cash flows or dismantle combination cash flows into separate parts. If value additivity did not hold, then financial engineers would be able to make excessive profits from something called arbitrage. We will say how to do such financial engineering in subsequent lectures. The basic idea of financial engineering is to mimic or replicate the cash flows from one security by building a replicating portfolio out of other securities. If you can form such a replicating portfolio, then it must be the case that the price of the thing that you can replicate must be related to the price of the parts used to build the replicating portfolio. Arbitrage is defined as the situation in which the cost of the replicating portfolio is different than the price of the security you're replicating. If such an arbitrage opportunity exists, then you can make money by buying the cheap one and selling the expensive one. Since many professional investors spend all day looking for such opportunities, we typically assume that value additivity holds. If it doesn't, it will hold fairly quickly. This is true because to exploit arbitrage, the traders, one, buy the cheap one, which bids the price up, and then you sell the expensive one, which lowers the price. They will continue to do this until the two prices converge and the arbitrage opportunity disappears. Thus, by exploiting arbitrage opportunities, professional traders make them go away. And to the extent that traders can only make profits for a short while, they must trade quickly. Thus, value additivity is going to mostly hold most of the time. Given value additivity, we can calculate the present value of a stream of future cash flows. Let's let that stream be denoted by CF at t sub 1, CF at t sub 2, CF at t sub 3, all the way up to CF at t sub t, where CF at c sub 1 denotes the first cash flow that occurs at time t1, where t1 is measured in years. Let CF t sub 2 denote the cash flow that occurs at time 2, where t2 is the time that cash flow occurs, etc., etc. According to value additivity, the present value of this stream is simply going to be equal to the cash flow of the first cash flow discounted back how many years? T1 years, plus the cash flow of the second payment discounted back at a rate R for T2 years, plus the cash flow of the third payment discounted back at a rate of R for 3 years, all the way up to the cash flow of the last payment that occurs after T sub T periods discounted back for T sub T periods. For example, with R equals 0.05 or 5%, what's the present value of receiving the following stream of payments? 100 at t equals 1, 200 at t equals 2, and 300 at t equals 3. The answer is the present value is equal to 100 divided by 1.05 raised to the 1. That's the present value of the first payment, plus 200 divided by 1.05 raised to the 2. That's the present value of the second payment, plus 300 divided by 1 plus 0.05 raised to the 3. That's the present value of the third payment. Add them all up, you get $535.80. Note, we can also consider situations in which we get and make payments. For example, consider the following situation. Let the interest rate be 20%. What's the present value of receiving a payment of 200 at t equals 2 and 100 at t equals 6, but making a payment of 300 at t equals 3? In that case, the present value is going to be 200 divided by 1 plus the interest rate, 0.2, raised to the second power, because we're discounting it back for 2 years. Then we're taking the cash flow of negative 300, we're discounting that back for 3 years, so that's negative 300 divided by 1 plus 0.2 raised to the third power. And then the final payment, which we get after 6 years, is going to be 100. The present value of that is going to be 100 divided by 1.2 raised to the sixth. When we add all that up, that turns out to be negative 1.23. The concept of the net present value is related to the last example. The net present value, or NPV for short, is calculated to evaluate the quality of an investment. Whether it is an investment in a financial security or an investment in real assets, such as a project in a corporation or a privately owned business, the key feature of most investments is that you spend something now to get future cash flows. The net present value is the difference between the present value of what you get and the present value of what you have to spend to get it. That is the net of the present values. Since what you spend is typically known and certain and is spent now, the value is not discounted. That is the cost of the investment. If you're investing in a financial security, it's the price of the security in the market now. If you're investing in a project for a corporation, it's the cost of starting that project now. The NPV of an investment is simply the present value of the future cash flows from the investments minus its cost. If the NPV is positive, your investment gives you a stream of future payments that is worth more than what you paid. That's a good investment. If the NPV is negative, then what you get is worth less than what you have to pay. That's certainly a bad investment. In some cases, the payments from a security or a real investment have a fixed structure. In some of these cases, there are special formula that simplify the calculation of the present value of that stream. For example, some investments generate a stream of equal cash flows at regular intervals that are at identical time space. For example, any fixed rate or fixed term loan is like this. The borrower pays a fixed amount every month for 60 months, say for 5 years. A rental agreement or a lease is also like this. The renter pays a fixed rent every month for the length of the lease. Anything that has a stream of equal payments is called an annuity. We can still calculate the present value of the sum of the PVs of the single parts, but there's a shortcut formula that can be applied. We will be able to understand the formula for the annuity if we first consider something called a perpetuity. A perpetuity is a generic name for a security that promises a fixed payment at evenly spaced intervals forever. The closest thing to a real-world perpetuity that I know is the British Council, which is a security issued in 1751 that was to replace existing British government debt. It consolidated debt, thus it was called a consul. This debt promised to pay an annual fixed payment of 3.5% forever. It turns out that it is not actually a perpetuity because they've reduced the coupon payment a few times since 1751. Thus, the payments for the council are really not fixed forever, as they are with an actual perpetuity. In the case of a perpetuity, we cannot simply add up the present values of each of the future payments, since there are an infinity of number of payments. However, as a result of some mathematics on infinite sequences and series, this actually allows us to come up with an analytic formula for this infinite sum. I'll show you the formula for this in a minute, but first, to give you an intuitive feel for how this infinite sum or values works, consider the following infinite sum. Let's say I'm standing in the studio 6 feet from the edge of the rug in the studio. Every time I take a step, I step halfway toward the edge. So my first step is 3 feet, putting me 3 feet from the edge. The next step is half of 3 feet, putting me 1.5 feet from the edge. The next step is 1.5 divided by 2, or 0.75 feet, and so on and so on. I keep on taking half steps. Notice that since I'm always having the distance to the edge of the rug, I never actually get to the edge of the rug. While I have an increasingly hard time making increasingly exactly half steps, if I could, I would never reach the end of the rug. I would continue to take half steps into the infinite future. A boring life for sure. But notice that through time, I will get closer and closer to the edge of the rug. So if we add up the total distance I've traveled, equivalently the infinite sum of each step size I took, the sum must be 6 feet, the original distance to the edge of the rug. That is, the limit of the sum of a number of steps doesn't go to infinity, it goes to 6 feet. So an infinite sum is actually a finite number. This is similar to the infinite sum of discounted future values. With the half-step problem, each subsequent step is smaller and smaller than the one before. With the present value problem, the present value of each subsequent payment is smaller than the one before. Each step size was the same. If each step size was the same, then the infinite sum would be infinity. It's the same as an infinite series of a series of ones. But because the subsequent present values, or step sizes, are smaller and smaller and smaller, the infinite sum is actually finite. In fact, the formula for the present value of a perpetuity that pays C dollars every period, with the first payment exactly 1 period for now, and a periodic rate of R, is C divided by R. For example, what's the present value of a perpetuity that pays $1,000 per year, with the first payment occurring after 1 year from today, if the annual discount rate is 12%? The answer is 1,000 divided by 0.12, or $8,333.33. Okay, let's look at the value of an annuity. Recall that an annuity is something that pays a fixed payment every period for a finite number of periods. If the number of payments is fairly small, then you can just calculate the present value of each payment and add them up. But if we're talking about a 30-year mortgage, then you have to calculate 12 times 30 for 360 individual payments, and then calculate the present value of each one of those individual payments, and then add them all up. What a pain in the neck. By the way, this reminds me of a story I once heard about Carl Friedrich Gauss, the famous German mathematician. When Gauss was just a kid, the teacher made him add up all of the integers from 1 to 100. Gauss turned the answer in after 10 seconds. Rather than brute force the answer by calculating 1 plus 2 is 3, 3 plus 3 is 6, 6 plus 4 is 10, 10 plus 5 is 15, etc., ad nauseum, Gauss noted that 1 plus 100 equals 101, 2 plus 99 equals 101, 3 plus 98 equals 101, and so on up to the 50th pair, 50 plus 51 equals 101, Thus, the answer is 50 times 101 equals 5,050. Done. We can use a similar trick to determine the present value of any annuity. The trick comes from value additivity and the fact that an annuity is simply a perpetuity with the tail cut off. Thus, the value of an annuity is the value of a perpetuity minus the value of the tail. To see this, let's look at an example. What is the value of a 5-year annuity that pays $300 a year with the first payment in a year? Let the interest rate be 15% or 0.15. Note that the value of a perpetuity that pays $300 every year with the first payment exactly in 1 year from now, when the interest rate is R equals 0.15, is what? 300 divided by 0.15, which is equal to 2,000. Note that after 5 years pass and the perpetuity is paid 5 $300 payments, that perpetuity will also be worth $2,000. In present value terms, that $2,000 value in year 5 is worth what? 2,000 divided by 1 plus 0.15 raised to the 5th. It's equal to $994.35 now. Thus, an annuity that pays $300 every year for 5 years, with the first payment being made exactly a year from now, is worth $2,000 minus $994.35, which is $1,005.65. In general, the formula for the annuity is equal to the PV of an annuity is equal to the cash flow divided by the interest rate, all of that multiplied by 1 minus 1 over 1 plus the interest rate raised to the t. For example, if we have $300 divided by 0.15, and then we subtract off 300 divided by 0.15, all of that multiplied by 1 over 1.15 raised to the 5, then we have what? The $2,000 minus the $994.35. That gives us the value of the annuity at $1,000 with $5.65. The last set of formula we will consider for both annuities and perpetuities are payments in which they're not fixed, but they're growing at a constant rate each period. These are called growing annuities and growing perpetuities. A growing perpetuity is one in which the periodic payments grow at a fixed rate G, where G, for example, would be something like 0.05 for 5%. If the first payment paid 1 period from now is C1, then the next payment is C2, which is equal to 1 plus G, all of that multiplied by C1. And the payment after that will be C3, equals to 1 plus G, all of that multiplied by C2, which, by the way, is equal to 1 plus G squared times C1. Given this structure, the present value of the stream is the present value is equal to C1, the first payment, divided by R minus G. One way to think about this without any growth in the payments, right? The future values are discounted. The farther in the future, the greater the discount. But if the cash flows are growing, that offsets this discounting. So think of the R minus G as the net amount of the discounting given the growth in the level of the cash flows. Note that if the growth is equal to or is outstripping the discounting, that is, if G is equal to R or greater than R, then the growth outpaces this discounting. In that case, the infinite sum is actually infinity. But when G is greater than or equal to R, then the formula gives you a bogus answer. It generates a negative number, when in fact the answer is really positive infinity. So be careful. If you ever use G that's greater than R, you're going to get a crazy answer. Don't use that formula. When the stream of payments lasts for T years, it is known as a growing annuity. The formula for that is C over R, all of that multiplied by 1, minus 1 plus G raised to the T, all of that divided by 1 plus R raised to the T. Like the annuity, a growing annuity is just the difference between the values of two growing perpetuities. Okay, now that we have a set of tools, let's see how we might use them to answer some very basic but important questions. For example, if you're 40 years old now, making a salary of $120,000 per year, how much do you need to save each year until you retire in order to have a nice retirement? Okay, there's lots of unknowns in this question, so we'll have to make a few assumptions about a few things, like what kind of return on savings can you expect to get on average? How long might you live? When are you likely to retire? How much of the current purchasing power you have in your annual salary do you think you want to have in retirement? So let's make some assumptions, and then on the basis of these assumptions, we'll be able to use the formula we've developed to answer that question. We can change some of the assumptions to see how sensitive our answer is to these assumptions. I'll let you do that. I should mention there are numerous websites that have calculators that do these kinds of calculations for you. One thing I've noticed is that you can get wildly different answers depending upon which site you go to. Since they do not actually show you exactly how they came up with the answers, all I conclude is that they make wildly different assumptions in the details of the calculations. So if you really want to know what's being assumed to see if that really applies to you, then you really need to make your own calculations based upon your own assumptions. So let's go through this example and you'll see how to do that. Let's say you expect to retire at age 65. If you're 40 now, you have 25 years to set aside a portion of your salary. According to the Social Security Administration, if you're currently 40 years old, you are expected to live for another 38 years if you're a male and 42 years if you're a female. But let's say both your mother and father lived well into their late 80s. So since you want to make sure that you have enough, let's figure out if you live to be, say, 85. Thus, you're going to need to save for 25 years and then live off the savings for 20 years. Let's ignore inflation and just look in real terms. Once you retire, you're not going to need to be paying off your house. So let's say that you want to consume in real terms the equivalent to $120,000 per year. Some years you may consume more, say go to Greece for a month, while other years you may consume less, spending more time with your grandkids as they grow up. But on average, you're going to need $120,000 per year. The next thing you need to assume is what kind of return you can expect to earn on your money while in retirement. If you want to not risk your savings, then we need to assume a fairly low number that is consistent with having your nest egg invested in low-risk securities. So in real terms, let's assume that you're able only to get 2%. So at age 65, you will need to have an amount of money that is equivalent to $120,000 per year for the next 20 years at a discount rate of 2%. That's just an annuity. For simplicity, let's assume that you get the money at the end of the year. So at 65, you retire, and 1 year later, you have to pay yourself an equivalent of $120,000 at the end of that year. An annuity of $120,000 per year for 20 years at 2% is worth $1,962,172, or $1.96 million. So you need to save an amount, let's call it X, every year for the next 25 years so that you have $1.962 million at the end of that 25 years. Notice that $1.962 million 25 years in the future is equivalent to what? It's equivalent to its present value, which is $1.962 million divided by 1 plus the interest rate of 10%, 0.1, raised to the 25th power. And that's equal to $181,100 now, if the interest rate is 10%. So to figure out what is equivalent to $1.962 million in 25 years, which is equivalent to $181,100 now, you need to figure out what annuity with payments at the end of the year for the next 25 years is equivalent to $181,100 now. That is, you need to solve the following formula. $181,100 should be equal to this value of X divided by the interest rate of 0.1 for 10%. All of that multiplied by 1 minus 1 over 1 plus the interest rate raised to the 25th power. If I solve for X, what we see is that that's equal to $19,951 per year. If we simply divide that by 12 to come up with a monthly value, that's approximately $1,662 per month. Better start saving now. So what we can see from these formulas is that we can answer some very interesting quantitative questions. And in subsequent lectures, we'll use these over and over again to do just that.